Kreditech, company from Hamburg, reinventing the way people get loans. Alexander, please give us an update. Also a very loyal guest at NOAH over the years.
Thank you very much, everyone. So let's speak about consumer credit. As you all know, consumer credit is one of the most important enablers of economic prosperity. Credit allows people to invest into the future by buying a house, buying a car, or by affording college education for their children. And most importantly, credit helps people to protect against economic uncertainty. And in case of an emergency, make sure that there's protection. The world of credit today is a two-class system. On the one hand side, you have people with great access to credit. On the other side, you have people with barely no access to credit. There is simply no middle ground. So let's look at those people with great access to credit. Those are people from the higher middle class, well-working, usually in fixed-term employment, and are well-earning. I would probably assume that most of the people in the audience belong into that category. Since 2008, the banks have been exclusively focusing on that customer segment because there's very little to no risk. On the other side, it looks very different. Underbanked are people that usually struggle to obtain credit with the mainstream financial institution. Those are pretty much the average people of a country. Hardworking people from the lower to middle class, usually employed, not necessarily in a fixed-term employment, but still hardworking to make a living. Their disadvantage is that they most of the time don't have a credit history, or the credit history is sort of like negatively affected, which means that banks don't really have a way to understand the risk of these customers and simply consider them a high-risk population and don't really want to do business with them. In a country like Germany, we consider that from all banking customers, around 42% of people are underbanked. If you look at to our neighbor at the east, in Poland, this share accounts to 47%. If you look to a country like Spain, this is already 60%. And in an emerging economy like Mexico, a breathtaking 80% of customers are considered to be underbanked. On a global basis, we estimate that there are around 2 billion people that do not have access to credit with the mainstream financial institution. So I'm asking myself the question, if banks are not focusing on these customers, there's actually a pretty big market opportunity out there. And this is exactly what we as Kreditech are focusing on. But first, let's understand why banks are not serving credit to this customer group. It's a problem of credit risk. Creditworthiness usually consists out of two very important properties. It's the ability to repay, and it's the willingness to repay. Ability means that I'm able to actually repay. Versus willingness means if I actually want to repay. Traditionally, both of them are answered by data that comes from the credit bureau. As you know, credit is a problem of asymmetric information. So by default, I don't really know anything about a person who's applying for a loan, which is particularly true in online lending, where you don't really see the customer even in first place. So what banks are doing is that they are asking the credit bureau, and the credit bureau most of the time contains information about past borrowings. And then they assume by saying, well, if someone was able to repay a loan in the past, we assume that they're willing and able to also repay a loan in the future and grant them a loan. Now, the thing with credit bureaus is that they're networks. So that means banks report information, and that's the issue, that in several cases, actually this reporting can be incomplete. Sometimes it's not reported at all. The information can be missing, it can be outdated. In case that someone has never actually applied for credit, there's not even any data there. And most importantly, if for some reason you miss to pay an invoice or you miss to make a payment, your credit history can be negatively affected for a couple of years. So all of that leads to the fact that when there is no data in the credit bureau, there's no rating, and without rating, there's no credit. Well, I'm asking myself the question, if it's really a problem of data, why do we have that nowadays? Because there's more data out than at any time ever before. By using mobile phones, with the footprint on web and social media, every person is producing more and more data every day. And that data actually gives pretty good indication about both ability and willingness. I mean, just to give you some example also, nowadays, I mean, data is very easy transferable. So for instance, if I grant API access to my bank account, I can very easily prove that I'm able to repay. Or by looking at my Facebook profile or my LinkedIn profile, I can confirm trust on my identity, which in turn would confirm my willingness to repay. All of that data for itself is not enough to make a credit decision, but in combination, it can be turned into a very powerful rating instrument. It's like pixels in a big screen, only in sum they form a very clear picture. So what happens if you combine these new data sources with modern age technology from machine learning and artificial intelligence? Well, you can build a very powerful instrument for credit rating. I mean, there's lots of talks about artificial intelligence nowadays, of machines writing songs and machines composing novels, and at the end of the day, machines taking over like all the jobs in the economy. We have a much more rational view on that. In our case, machine learning is simply a tool that helps us to cope with a data set with lots of input factors. So we have developed a solution that works well on a very big set of unstructured data, and helps us to identify patterns there. And traditional statistics would simply not be able to do that. The advantages are very clear. With that system, we can take credit decisions in real time. We can work under incomplete information. And most importantly, we can produce a credit rating for underbanked customers. And that's really the core and our competitive edge of what we have developed. Let's take a look at our company. So we started in 2012, so we're now on the market since 4 years. Last year, and up to date, I mean, we have processed more than 3 million credit applications. We have originated by now more than 200 million euros in consumer loans and finished last year with 42.5 million euros in revenue. We are backed by very prominent investors and closed our Series C financing round last year with around 90 million euros raised in equity. Just to give you some perspective, the total amount of capital invested into Fintech in Germany last year was 170 million euros. So that means we actually raised more than 60% of that. Taking a closer look at our business model, we are an end-to-end consumer service provider. Means we acquire customers, we take credit decisions, we fund loans, and we service loans over their lifetime. And we all do that with our proprietary technology, and we have automatized most of the parts of the value chain, which is great for the customer because that means we're open for business 24 hours a day, 7 days per week. It just takes a couple minutes to submit a credit application, and we give a decision in seconds. On the funding side, we're not a marketplace. It means we work with securitization, and we always, contrary to marketplaces, participate on the credit risk, which in our point of view is important because it sets the right incentives. The products that we offer, so broad range of consumer finance products, ranging from very short maturities, lending 100 euros for 7 days, up to a couple thousand euros on a personal loan space to be repaid over a couple of years. And we recently introduced a point-of-sale financing product that allows retailers to use our technology to offer fast, on-the-spot point-of-sale finance. We're active in 5 markets: Poland, Spain, and the Czech Republic in Europe, Russia, and Mexico and Latin America. We're locally regulated in all the markets and, of course, compliant up to the highest standards. Last but not least, a couple words on a topic we're very often confronted with: interest rates. The rates and the cost of credit we are charging varies by product and by the risk category of customers. The highest cost of credit we are charging is around 30% for a 1-month loan, and on the lowest end, it's around 12% for a 1-year loan. So for those of you in the room who have access to prime credit, probably say, wow, this is actually pretty high. But you shouldn't forget that the customer segment we are serving is inherently risky. To give you a feeling, if you don't apply our technology, around 50% of customers would end up not repaying. So that's completely different to the segment that banks are operating in. And the goal of us as a company is to make sure that we give every customer the best possible credit offer based on their personal situation and their credit risk. And that means if you use our technology to evaluate the ability and the willingness to repay, and both of them are high, we make a personal loan offer at low cost of credit. If either one of them is low, we think it's actually better not to make a credit offer at all. And if they're at the margin, we still think it's actually good to give this person access to a small amount of credit to offset emergency funding needs. The important thing for us, however, as a company is that we take people from there, from being a microloan customer, which is a product that, of course, assumes that some people would end up not repaying. And over time, while we develop, a relationship with the customer, we improve the borrowing conditions. So to sum it up, our goal as a company is to give people better control of their lives by giving them access to finance and change the world so that credit is no longer a two-class system. Thank you very much.